My name is Owen Kazmarek, and this is the story of how the president of my homeowners association spent nearly 4 years quietly inflating vendor contracts and pocketing the difference, and how my background in municipal finance auditing turned a single suspicious landscaping invoice into a criminal fraud case that removed him from power for good. I bought my townhouse in the Willowbrook Commons community 6 years ago, drawn in part by the neighborhood's well-maintained common areas and reasonable HOA dues, which at the time sat at a modest $210 per month, covering landscaping, a small clubhouse, a community pool, and general upkeep of shared spaces. I want to note, because it matters to how this story unfolds, that my professional background is in municipal finance. For 12 years before transitioning into private consulting, I worked as an auditor for a state agency responsible for reviewing local government budgets and flagging irregularities in public spending, a career that trained me, in a very specific and durable way, to notice exactly the kind of thing that most homeowners, understandably, never think to look for in their own HOA's financial statements. The HOA president during most of my time in the community was a man named Dale Fenwick, a longtime resident who'd served in the role for nearly 8 years by the time this story begins, well-liked in the general, surface-level way that comes from decades of friendly small talk at community events rather than any deep scrutiny of his actual performance in the role. Dale ran unopposed in nearly every annual board election during his tenure, a pattern I now understand, in hindsight, was itself a mild warning sign, since a genuinely engaged HOA community typically sees at least occasional competitive interest in board positions, particularly one as consequential as president. The specific detail that first caught my attention arrived, somewhat mundanely, through our HOA's annual financial disclosure, a document every homeowner is legally entitled to receive under our state's community association statutes, summarizing the association's income and major expenditure categories for the preceding year. Most homeowners, I suspect, glance at these disclosures briefly if at all, trusting that the board has handled things appropriately. I read mine closely, out of professional habit more than any specific suspicion, and noticed that our landscaping contract, held with a company called Greenscape Premier Services, had increased by nearly 30% over the preceding year, a jump that struck me as unusually steep given that our dues had only increased by a much smaller, more typical 5% during that same period, a gap that meant the association's reserve fund, meant to cover major future repairs like roof replacement or pool resurfacing, was being drawn down to cover the difference. I want to be clear that a 30% increase in a landscaping contract is not, on its own, necessarily evidence of anything improper. Costs rise. Contracts get renegotiated. I initially assumed there was a reasonable explanation, perhaps an expanded scope of services or a broader market increase in landscaping costs across the region, and I raised the question at our next quarterly homeowner meeting, expecting a straightforward answer. Dale's response, delivered smoothly and with the easy confidence of someone who'd fielded many homeowner questions over 8 years in the role, was that Greenscape had taken on additional seasonal work and that rising fuel and labor costs across the landscaping industry had driven increases across the board, an explanation that, delivered verbally in a room full of other homeowners who seemed satisfied by it, felt reasonable enough in the moment that I didn't push further during the meeting itself. But my professional training, the same instinct that had served me well through 12 years of catching irregularities in municipal budgets, made me want to verify this explanation independently rather than simply accepting it, particularly given how significant the reserve fund drawdown implications actually were for the long-term financial health of a community I'd invested my own home equity into. I requested, through our HOA's formal document request process, which every homeowner is legally entitled to use under our state's association transparency laws, the actual Greenscape contract along with the association's full itemized expenditure ledger for the preceding 2 years. It took nearly 6 weeks and 2 follow-up requests to actually receive this documentation, a delay that Dale attributed to our HOA's small, volunteer-run administrative capacity, an explanation that felt plausible on its own but that, once combined with what I eventually found in the documents themselves, took on a different significance in hindsight. When the documentation finally arrived, I spent several evenings doing exactly what my old job had trained me to do, comparing the contract's stated terms against the actual invoiced amounts, checking whether the service scope described in the contract matched what our community actually appeared to be receiving, and checking Greenscape's pricing against publicly available rate information for comparable commercial landscaping services in our region. The specific discrepancy I found was subtle but, once identified, unmistakable. Greenscape's invoices consistently billed for services at a rate roughly 40% higher than what I could find for comparable landscaping contracts serving similarly sized communities in our county, information I was able to gather by directly calling 3 other HOA boards in neighboring communities and asking, simply, what they were currently paying for comparable landscaping scope, a research step that most homeowners, again, would likely never think to take, but that felt entirely natural to me given my professional background in exactly this kind of comparative cost analysis. I want to describe the moment I found the piece of information that moved this from concerning cost discrepancy to something I felt required formal action. While researching Greenscape Premier Services itself, checking its business registration and licensing status as part of my routine due diligence, I discovered that the company had been registered just under 5 years earlier, almost exactly matching the timeline of when Dale had become HOA president, and that its registered agent, the individual legally responsible for the business, was a man named Curtis Fenwick, whose last name matched Dale's, and who, according to a public social media profile I was subsequently able to locate, was in fact Dale's brother-in-law. This discovery reframed everything I'd found up to that point. What had initially looked like a possibly legitimate, if unusually steep, market rate increase now looked like something considerably more troubling. Our HOA president appeared to have steered a significant, multi-year landscaping contract toward a company owned by his own brother-in-law, at rates substantially above market, without ever disclosing this family relationship to the board or the broader homeowner community, a non-disclosure that, under most HOA governance bylaws including our own, constitutes a serious conflict of interest violation independent of whatever the actual pricing turned out to reveal. I brought my findings, organized into the same kind of structured, evidence-based memo I used to prepare for actual municipal audits, to 2 other board members I trusted, both of whom I'd gotten to know over the years as genuinely engaged, good-faith participants in our community's governance rather than simply rubber stamp votes for whatever Dale proposed. Both were, understandably, shaken by what I showed them, and together we made the decision to formally request an independent financial review of the association's full books, a step our bylaws permitted upon a petition signed by a threshold percentage of homeowners, a threshold we were able to meet relatively quickly once we explained, carefully and without yet naming Dale directly, that we had specific, documented concerns about vendor contract irregularities. The independent financial review, conducted by a certified public accountant specializing in community association audits, someone the board retained specifically because of her independence from any existing relationship with Dale or the association's prior financial management, took approximately 10 weeks to complete and confirmed what I'd found, extending it considerably further than my own initial research had been able to reach. The audit revealed that Greenscape Premier Services was not the only vendor relationship involving an undisclosed connection to Dale, a separate pool maintenance contract, awarded roughly 3 years earlier, traced to a company whose ownership records led back to a close personal friend of Dale's, again at rates the auditor determined to be substantially above the market range for comparable services in our region. Combined across both contracts over the full period they'd been in place, the auditor's final report estimated that the association had overpaid by approximately $231,000 relative to fair market rates for equivalent services, a figure that, while it did not necessarily mean Dale had personally pocketed the entire overpayment directly, since some portion would have represented legitimate cost to run the actual businesses involved, nonetheless represented a serious, sustained pattern of self-dealing that had drained our communities reserve fund far more significantly than any of us had previously understood. The board, once the audit's findings were finalized, called a special meeting to present the results to the full homeowner community, a meeting I remember as one of the more tense and difficult evenings I've experienced in 6 years of living in Willowbrook Commons. Dale attended, and when directly asked about his relationship to both vendors, did not deny the family and personal connections once they were laid out explicitly with the supporting documentation, though he offered a defense that both contracts, in his characterization, had provided genuinely good service and that any pricing premium reflected reliability and responsiveness rather than deliberate self-dealing, an explanation that, once weighed against the specific, quantified market rate comparisons the independent auditor had assembled, failed to persuade the assembled homeowners or the board. The community voted, through a formal recall process outlined in our bylaws, to remove Dale from the board entirely, a vote that passed with an overwhelming majority. Separately, the board voted to pursue civil action against Dale to recover a portion of the documented overpayment, a process that ultimately resulted in a settlement, since a full trial would have been costly and time-consuming for a volunteer-run association. but one that required Dale to personally repay $85,000 to the association's reserve fund over a structured multi-year timeline, an amount reached through negotiation that the board's attorney advised represented a reasonable outcome given the practical challenges of proving the full theoretical overpayment amount in court with certainty sufficient for a larger judgment. Our HOA terminated both the greenscape and pool maintenance contracts and conducted a formal, competitive bidding process for new vendors, a process that, notably, resulted in landscaping and pool maintenance costs dropping by roughly 35% from what we'd been paying under Dale's arrangements, savings that allowed the board to actually reduce monthly dues slightly for the first time in the community's history, a change that, more than almost anything else, helped rebuild homeowner trust in the association's governance going forward. I ended up running for the board myself in the election that followed Dale's removal, a decision I made somewhat reluctantly, since I genuinely just wanted to live in my home and enjoy a well-run community rather than take on an unpaid governance role. But having spent months deeply immersed in exactly the kind of financial oversight our association clearly needed more of, it felt like the natural next step, and I've served as our treasurer for the past 2 years, implementing exactly the kind of independent verification and competitive bidding requirements that, had they existed before, would likely have caught Dale's arrangement long before it drained $250,000 from our shared reserve fund. Dale built his entire arrangement on an assumption that, I think, is common among people who exploit positions of unpaid, informal community trust, that homeowners, busy with their own lives and generally inclined to assume good faith from their volunteer leadership, would never actually cross-reference a landscaping invoice against comparable market rates, would never think to check a vendor's business registration for a familiar last name. He had no idea that one of the homeowners quietly reading through his annual financial disclosures had spent 12 years being professionally trained to do exactly that, and that the modest, unremarkable habit of actually reading the documents he was legally required to send us would end up costing him $250,000 and the community standing he'd spent 8 years carefully building.